I have been looking at the same data long enough that it stopped feeling like analysis and started feeling like a warning. At first, I assumed I was just tired. That my eyes were filling in gaps that were not really there. So I stepped away. I came back later. Then again. Same result every time. The numbers refused to behave. On the surface, everything looked familiar. A violent move. A historic drop. The kind of market event that gets labeled, categorized, and filed away as another crash. But the longer I watched, the more uncomfortable it became. This was not chaos. It was precision. Not randomness. Sequence. When markets panic, they don't discriminate. They sell everything connected to the problem, and usually they sell the weakest parts hardest. That is how stress normally expresses itself. This time, the stress had edges. Clear ones. Silver collapsed in a way that forced people out. Not slowly. Not gently. Fast enough to trigger margin calls before logic could catch up. Screens lit up with losses. Positions vanished. The reaction was exactly what you would expect when leverage meets gravity. But the system did not respond evenly. Some parts absorbed the shock. Others barely moved. And that is where the story changes, because markets can fake prices for a while, but they cannot fake behavior under stress. By the end of the first night, one thought kept repeating in my head. If this was a real collapse, it would not look like this. And that realization leads directly to what nobody wanted to look at next. The official explanation arrived almost instantly. Silver had run too far. Too many people piled in. Leverage got reckless. The unwind was inevitable. Clean. Logical. Morally satisfying, even. Greed punished. Excess removed. It sounded right because it always sounds right. Every bubble story uses the same language. Overextended. Euphoric. Unsustainable. The vocabulary exists to make the outcome feel deserved. It gives people closure. It lets them believe the system corrected itself. But there is a problem with that story. In real market purges, the damage spreads outward. The core asset falls, and anything dependent on it falls harder. Producers. Derivatives. Businesses tied to cash flow. The pain compounds because revenue assumptions break. That did not happen here. Silver collapsed violently. The companies whose entire existence depends on silver prices declined, but not in proportion. Not even close. They moved like they were reacting to bad headlines, not existential math. That is not sentiment. That is not optimism. That is positioning. At that point, explanations started to feel evasive. They were already cheap. They're long-term plays. The market is forward-looking. Those phrases are useful because they stop questions. They are vague enough to end curiosity without answering anything. But markets do not respect narratives. They respect constraints. And the constraint here was obvious. If silver was truly repriced lower in a durable way, the economic value of extracting it should have been repriced lower immediately. That disconnect is not noise. It is information. The question is why. Panic has a very specific signature. Correlations spike. Everything becomes one trade. People sell first and ask questions later. Even strong assets get dragged down because liquidity matters more than conviction. This was different. Retail behavior looked exactly like panic. Forced selling. Margin calls. Liquidations happening faster than decisions. That part made sense. Institutional behavior did not. Large pools of capital did not rush for the exits. They did not abandon exposure that should have become toxic overnight. They absorbed volatility without capitulating. That only happens under two conditions. Either the players involved have unlimited tolerance for pain, or they believe the pain is temporary and mechanical. Institutions do not rely on intuition. They rely on structure. On rules. On knowing where pressure must release and where it cannot. They survive by understanding which moves are opinion-driven and which moves are enforcement-driven. Silver's move had the feel of enforcement. Not people deciding silver was worth less, but accounts being forced to sell silver at any price to satisfy collateral demands. That distinction matters because it changes what the price actually represents. At that point, the crash stops being a verdict and starts being a process. And once you see it as a process, the next step is obvious. Follow the force. Every leveraged market is held together by one quiet rule: volatility is tolerated only as long as collateral can cover it. When volatility spikes, the system does not debate fairness. It demands cash. Margin is not a suggestion. It is a command. When prices move violently, margin requirements rise. That forces traders to either add capital or exit positions. Most cannot add capital fast enough. So they sell. That selling pushes prices lower, which raises volatility further, which triggers more margin demands. The spiral feeds itself. This mechanism is not designed to discover truth. It is designed to prevent defaults. And when it activates, price becomes secondary to survival. The silver collapse had all the hallmarks of a margin-driven purge. Speed. Timing. Uniform damage to leveraged participants. And then something even more telling. The tightening did not stop when the damage was done. Margin pressure increased after the crash, not before. That sequence matters. It means the system was not calming the market. It was finishing the cleanup. That is when it stopped feeling like risk management and started feeling like containment. Containment is what happens when someone, somewhere, cannot afford disorder. If silver had truly become cheaper in an economic sense, the physical market would have responded immediately. Inventories would have loosened. Premiums would have collapsed. Sellers would have competed for buyers. The opposite happened. Physical silver became harder to source. Premiums widened instead of shrinking. Dealers hesitated. Availability tightened. That is not how real price discovery behaves. A falling paper price alongside tightening physical supply is a red flag the system cannot hide. It means the paper market is clearing positions, not clearing supply and demand. Paper can be liquidated infinitely faster than reality can adjust. Mines do not expand output overnight. Industrial demand does not disappear in a weekend. Supply chains do not reconfigure because a futures contract printed lower. This is where the abstraction breaks. The paper market was screaming, cheap. The physical market was whispering, scarce. When those messages diverge, the screen stops being a mirror and starts being a distortion. And distortions always show up first where leverage is highest. Once you recognize the pattern, history becomes uncomfortable. Silver has followed this script more than once. A powerful rally. Public attention. Leverage buildup. Then rule pressure. Margin hikes. Forced exits. Violent collapse. Silence. Recovery. Different years. Same structure. The system does not need coordination to repeat this behavior. Incentives are enough. Clearing systems protect themselves. Large capital survives collateral regimes. Smaller capital does not. The result is always the same. Assets transfer from weak hands to strong hands under the cover of market forces. The narrative blames speculation. The mechanism rewards liquidity. That is not a conspiracy. It is architecture. And architecture does not change just because people complain about it. When a market purges leverage, the purge eventually ends. Not because fairness returns, but because there is nothing left to liquidate. After that, prices stop being driven by forced selling and start being driven by constraints again. Supply. Demand. Access. Time. That transition is rarely smooth. The paper market stabilizes first. The physical market follows more slowly. Premiums linger. Availability remains uneven. Volatility stays elevated because confidence does not return all at once. This is not a prediction. It is how constrained systems behave. Institutions know this. That is why behavior diverged when the crash hit. Not because anyone knew the future, but because they understood the mechanism. And mechanisms, once activated, do not negotiate. The real story here is not silver. It is the moment the market reminded everyone that price is not value, and paper is not reality. That abstraction works only as long as nobody tests it under stress. This event tested it. The system responded by enforcing collateral, purging leverage, and hoping the physical side would fall in line afterward. It might. It might not. That part is beyond anyone's control. What is already clear is that something fundamental shifted. Markets are supposed to translate reality into prices. When they start forcing reality to conform to prices instead, cracks appear. Those cracks do not announce themselves. They show up quietly, in divergences, in behavior, in things that refuse to move the way they should. Once you see that, crashes stop looking like accidents. They start looking like signals. And this one was loud enough to change how everything after it should be read.